Hello ladies and gentlemen, my name is Waqar Asim and welcome to this WWA webinar. So today in this presentation, we want to bring to you something different. We want to explain to you, as you must have seen, how you got to this point. We do trading a little bit differently. We don't like strategy-based approach to the market. We don't like probabilistic scenarios. We don't like looking at things from a perspective of chance and luck. We would rather use the market from a perspective of facts. Looking at market facts, looking at market cycles, and developing a trading plan to capitalize based on factual points of the markets as opposed to probabilistic points of the market. The reason why this is so critical is because this greatly enhances your risk to reward ratio. The industry standard, as I'm sure you all know, 1-to-1 risk to reward, 1-to-3 risk to reward, maybe a lifetime trade might be 1-to-10 risk to reward. Ourselves at WWA Trading, we are more used to 1-to-10 as our minimum, and we have done trades 1-to-50 risk to reward, 1-to-100 risk to reward. And not only ourselves, countless number of our students are replicating the same. At first, bold claims like these come with huge skepticism, and that is completely understandable. But when we break it down in this webinar, we're going to try and explain how can we get this kind of risk to reward in the market from a precision basis, how we can refine our entry, how we can refine our stop losses to get a point where our risk is completely minimal, our zone of invalidation is very, very small, and therefore we can capitalize on moves where a 300 pip move, for example, with a 100 pip stop loss, is only a 1-to-3 risk reward. But if you catch that identical move in the market where your stop loss was 5 pips, your risk reward will be phenomenal. And that is our sole basis in our trading, how we can maximize that risk to reward. Throughout this presentation, I'm going to be taking you through our modeling and how we like to view the market and what we believe are facts of the markets that are non-negotiable. Therefore, it is a must. We are utilizing this in our trading. And then how we encompass this into a strategy, utilizing various schools of thoughts. That's how we combine and amalgamate our trading plan. And that's what I want to share with you all today. So ladies and gentlemen, get yourselves comfortable. I'm going to go ahead and share my screen and let's begin with the WWA Masterclass. Okay, so first of all, we need to establish what is important for us in terms of traders. What is our responsibility? Because everything is out of our control. The market is out of our control. Geopolitical factors are out of our control. Economies are out of our control. Everything we do not have a say in. But we do have certain things we can certainly have control upon, and therefore we need to adhere to these and maximize these. The two things I believe are the factors we can control is your risk to reward and your risk management. Risk management is something we have all battled with from our early days in trading to this point, overcoming over leveraging, things like that. But you have to think of your trading account as a portfolio. Imagine yourself as a fund and how you would manage your capital for your clients. So risk management therefore is essential, and that should be something we are not modifying. Secondary to that is your risk to reward ratio. Now that is where WWA Trading specializes. Risk to reward ratio is not only the difference between having profitable versus optimal trading, but it also has a whole dynamic effect on your portfolio. Imagine if you have a higher risk to reward ratio, you can afford more losses in your account. You can afford more break-even trades, and therefore you have less fear of missing out. You have less greed in the market. It affects your psychology. Maximizing on your risk to reward takes account of a lot of factors that would ordinarily be problems for traders. And lastly, you don't want to be risking your hard-earned money into the markets if you are not establishing a reward that is justified to put your money at risk and expose it to the market. Therefore, we need to think of it from that perspective also. So our modeling is slightly different to the traditional school of thought, where the traditional school of thought will be looking at more strategic approach to the market using probabilities or various schools of thought. You may be using them yourselves right now, a foundationary one being trend lines, Fibonacci. You can use harmonic patterns, different schools of thought, for example, Elliott wave theory, the market maker method, Gann theory, market geometry and market patterns. All of these things we've all come across and studied. But in reality, what are they? They are looking at the market from chance or theories or probabilities. Whereas what I like to do at WWA Trading is look at facts of the market. Not theories based on chance and probability, but actually what is driving price and what is modifying different conditions in the market between supply and demand, between buyers and sellers. So the factors that underpin real price movement is obviously supply and demand. Now, think of this like a game of chess between buyers and sellers, and the market is simply a digital footprint of that exchange of supply and demand. Something that people don't really utilize in their trading understanding is the market cycle. We need to understand when we are in accumulation phase, when we are in a distribution phase. We need to understand why the market is consolidating. And if the market isn't consolidating, is that for a bullish reason or is that for a bearish reason? We need to understand, are we in a pro-trend market or a counter-trend market? We need to understand the bigger picture to therefore understand what our trading bias should be. So that therefore is an essential criteria to understanding where we have a starting point in the market. The next thing I want you to understand is what is liquidity. Liquidity is essentially where price is held, where stop losses are held, institutional levels, and when price breaks through those levels, we free up liquidity in the market, and that freed up money is essentially what moves price. So if we don't understand what is the underlying basis of price movement, we will not be able to effectively trade. Therefore, we need to understand these facts of the market. So I'm going to go through some of the common features that we are all used to and we have all heard of, for example, Fibonacci. So Fibonacci is a very romanticized concept in my opinion. It is a nature number, it is found in space, it is found in the oceans, it is found in the human body, but that does not necessarily mean it applies to the financial markets. If you are to look at any impulse and retracement and you are to backtest any time frame on any currency pair, you'll realize, looking at a bell curve which I have on the right of the screen, from a probabilistic perspective, the majority of these retracements happen between the 61.8 and the 78.6 Fibonacci numbers. Therefore, we can say this is our zone of confluence. This is where there is a high probability chance that a retracement will lie, and therefore we are trading probabilities and statistics as opposed to what was price really telling you at that point in time. Therefore, you are trading concepts and strategies as opposed to market facts. That, I believe, is an issue. Secondary to that is trend lines. So as we can see on the screen, I have drawn many trend lines in a very narrow range in price. We can see the red line has 4 points of contact, is a very valid trend line, and in the end it goes on to be invalidated. Same for the orange one, it touches 3 times but goes on to be invalidated. So now we can see from this, how would we know which is the true trend line to use? We have 4 or 5 variations at the same point in price, and we wouldn't know which one to choose. And all of them go on to be invalidated. So we have multiple options, it's very subjective, there's ambiguity in knowing which one to trade, and therefore in my opinion it is inconsistent and more random. And if you are to get a trade based on a trend line, it was more chance and luck as opposed to that trend line really being respected. To really demonstrate that point, I'm going to use the same piece of price and look at it from a perspective of order flow. So in conclusion, we can see that utilizing a trend line, we would not really know which one to trade. It would be very ambiguous depending on who is trading the account, which would be the real entry. Very subjective. Therefore, it can lead to multiple losses and more confusion in the market as opposed to clarity. This is a very common excuse I've heard a lot. Myself too, when I was learning how to trade, it would be a very common phrase from various mentors: market manipulation. Now, if we think of what really market manipulation is, the markets is trading trillions of dollars every single day. The vast majority of that is from governments and financial institutions and hedge funds. And retail traders only account for a very small percentage of that. If we look at the markets from a perspective of bank versus bank, and they are trying to profit from each other, and retail traders are only feeding in a very small percentage of the capital in the market, we can realize these market manipulations or stop loss hunts are not really the objective of what the financial institutions who drive price, that is not their real objective. So as we can see on the screen, to validate a trend line you need 2 points of contact, and they say the third point of contact is the most high probability. In this situation, the third one had a stop loss hunt or market manipulation, as people say. So how would we know? How can we justify that? How would we know if there's a market manipulation about to happen? How could we know how to avoid that loss? Or do we just blame the market and say that was chance and we got unlucky? I think that is a very ill-informed way to view the market, and I think we need to utilize greater strategies and greater concepts to understand why these factors in the market really happened. So to really demonstrate that point, I'm going to use the same piece of price and I'm going to show you what really happened. This is how I would look at the market. At WWE Trading, we like to look at order flow, which is one of the things we believe is a fact of the market. And in this example, you can see even where there was a manipulation hunt, that happened for a reason, to facilitate order flow in the market, and therefore we can see if you are trading from a perspective of market facts as opposed to market strategies, you would have been able to understand this market manipulation that quote unquote happened. So another thing I want to discuss is the concept of support and resistance, which is a cornerstone of any retail trader strategy. Now, looking at the screen, we can see to verify an area of support and resistance, we just need 2 points of contact. So here we have 3 points of contact, invalidated. 2 points of contact, invalidated. Turned into resistance, invalidated. So you can see again, just like the trend line, it is very subjective, it's very ambiguous, and you wouldn't really know which one to trade. But when you're looking at it in hindsight, it's an explanation that, okay, this was a support and resistance level. But in real-time trading, it does not become something we can really utilize from a precision basis. So again, as was the case with the trend line, this would lead to multiple losses, confusion, ambiguity, and it is down to being very subjective also. So again, this is a strategy-based approach to the market as opposed to looking at what was the real factors that drove price in this manner. So I'm going to utilize the same piece of price again, and I'm going to show you how we would view this at WWA Trading. So another thing I really want to emphasize is the importance of liquidity in the market. As we can see here, raw price action is the foundation of anybody's trading plan. And we can see here that we were in a clear downtrend from forming lower lows and lower highs. But now we did have a switch in trend. We had bullish break, but the downtrend proceeded. So we need to understand why did that happen. We can see because of factors of liquidity. Here you can see there was a triple bottom, and this is where retail orders would come into the market. Their stop losses would be lying right below. So when this spike happens, and this would be considered a stop loss hunt, this in reality was weak-handed buyers being taken out of the market and having enough strength to push past this resistance level and therefore liquidate this area too. So we can essentially see right here there was a battle between supply and demand, between buyers and sellers in the market. And therefore if we were only looking at structure and we were only looking at trend lines and we didn't consider what liquidity was telling us, what was driving price, we would have likely taken losses. Right here we saw that sell side liquidity was taken and buyers had strength. And then here, buy side liquidity was taken and sellers had strength. So essentially here, right where the liquidity is lying, where stop losses are lying, that is the money that is freed up that allows price to continue. Next, I want to talk about the market cycle and utilizing Waqar theory. This is a school of thought that goes back generations, but it still applies to this day, and it is around 20% of our market understanding, but a very crucial point that we need to understand. So here we can see on the screen a complete market cycle where we have zones of consolidation and then expansion, consolidation, expansion, and so forth. Now, all of these phases of consolidation is where buyers and sellers are interacting in the market, a battle between supply and demand, and eventually we have a breakout. So if we did not understand at what point in the market cycle we were, we would very easily be caught out and we would not know which buyers to trade in the market. Accumulation generally being preparation for a bullish market, reaccumulation is continuation of trend, and distribution is where the market shifts from a bullish market to a bearish market. Therefore, from a risk reward perspective, we can understand how critical this can be, because we can get a whole swing trade or even a whole position trade if we understand where the market cycle is, and if we can understand precision in our trading. If we can take our entries down to the 1 minute time frame or even the seconds time frame, we are able to get a swing trade with a scalp style entry, therefore maximizing our risk to reward. So now on the next slide, I'm going to show you a real life example of a market cycle where we had a phase of accumulation and then expansion, reaccumulation, expansion, and now a distribution to change trend and enter a bearish market. So if at any point in the market you did not understand the greater picture, you could very easily get caught out if you were utilizing trend lines or Fibonacci and you did not understand the underpinnings of the market, you would not have maximized your trading. Here we can see a side-by-side example of an accumulation schematic in theory and how it presents in reality. Now again, I don't want to teach too much right now today in what each of these points mean and how to trade it, but I just want to show you the importance of how understanding this would enable you to catch a huge bullish move. The same applies for distribution. On the right we have a schematic in theory, and on the left we have a real life example, and you can see how very closely it is linked to what is dictated in theory. And again, if you were to understand at which point in the market cycle you were, you would be able to capitalize on a whole position trade. So in the next few slides, I'm going to show you some real life examples of trades we have taken and the kind of risk to reward we can get by really understanding true factors of the market. These are all trades that we have journaled publicly and is available for anyone to analyze with real time stamps, live trading. First of all is an example of GBP NZD. It was a distribution schematic happening, and our entry and MetaTrader entry can be seen on the right. This trade yielded a 1 to 40 risk to reward and 550 pips. And at the time of recording this webinar, it is at a 1 to 90 risk to reward and achieving over 1,000 pips. Next, we can see a GBP NZD accumulation. And again, we can see factors of liquidity, liquidity hunt, and an accumulation schematic. And this is our real life entry. This trade was over 1,400 pips and a 1 to 50 risk to reward. Now, one thing I want to emphasize is velocity in your trading. Velocity in your trading is also very important because majority of hedge funds globally, they'll get a percentage yield for their clients between 10 and 30%. And you can see here, if you risk 1%, you could have achieved 50% of your account growth in one single trade, therefore outperforming majority of hedge funds in just 4 days. That is the power of precision trading and maximizing your risk reward ratio. The next trade I want to show you is USD JPY. It is a type 4 distribution, and this trade was a 1 to 100 risk to reward. Again, you can see the MetaTrader screenshot, and again, this was all journaled and documented live and can be seen on our Telegrams and Instagram. Again, if you risked 1% of your account, you could have had a 100% return on investment, and again, it only lasted 4 days, emphasizing the velocity in your trading. GBP USD, another accumulation based trade, 1 to 100 risk to reward and achieving over 1000 pips. Slightly longer at 22 days. Again, we can see the MetaTrader screenshot. Another trade is a gold long that I'm currently in. Right now, at the time of recording this webinar, I've been holding this trade for 2 months and approaching 3000 pips. Again, we can see the MetaTrader analysis. So at the end of this webinar, I want all of you to actually go ahead and check out our public Telegrams. There we have over 1 year worth of data where we show our live trades before and after and documenting the whole process. So you can see our psychology, our thought process, how we were analyzing things day by day, when to exit a trade, when to continue holding a trade, how we would look to enter. All of these factors can be seen, and that is actually something you can all use to backtest and use as a free resource to improve in your own trading. But the main thing I want you to realize from this is that this is showing the power of true precision trading, maximizing your risk to reward by understanding the market cycle and other facts of the market. And if you want to have a deeper look at our case studies of certain trades, we actually publish these on our Instagram, which I implore you to go ahead and follow as well. So ladies and gentlemen, let's get to some more interesting theory now. I'm going to be showing you some real life examples and case studies from the start to the end as a top-down analysis, and we can see how utilizing typical retail strategies as opposed to our methodology, what kind of differences they would have. So looking at this piece of price, I would simply ask, how would you analyze this right now? Would you look at, for example, apply a Fibonacci retracement? Would you add a trend line, support and resistance, analyze market structure, moving averages, different indicators, and maybe some more advanced analysis utilizing Elliott wave theory or high zones of confluence where multiple factors line up in the market? I would consider this a high level retail analysis because we are not only utilizing trend lines and major support and resistance levels where our zone of confluence lines up over here, where we have our Elliott wave lining up where AB equals CD. We also have our trend line, we also have a major resistance level, and we have our 61.8 retracement. And now we have also refined the stop loss not to be based solely on the Fibonacci, but actually the previous structure points. So this would actually be a high level retail analysis. Let's see how this plays out. So we can see this actually went on to hit stop loss. Even though we had so many areas of confluence, even though we had a strong resistance level, we had a trend line, we had our Fibonacci, we had a wave count, in the end, it would have either been a break-even trade or a stop loss. Price did come into a little bit of profit, and it took 7 days to return to break even or stop loss, depending on how you manage your trades. So I just want to ask you, is this really a good use of your time and capital? To hold a trade in drawdown or floating slightly in profit for over 7 days, maximizing at just 3%, which you probably would not have even attained because it went on to reverse and hit break even or stop loss. This is not precision trading and this is not efficient trading. And the reason this happened, I will go on to explain in the next slide. So looking at that same piece of price, this is how we at WWE Trading would analyze this. We would identify different points of market structure. We would understand where is true supply and demand and what is raw price action telling you. We'd also look for points of liquidity, and the main thing we would look for is the accumulation schematic that is starting to build. We are in a zone of consolidation where the market is preparing for a bullish phase, and if you were simply looking at structure and seeing these as lower lows and lower highs and therefore anticipating a bearish market, when in reality the market is preparing for a bullish phase, you would be on the wrong side of this trade. So to briefly elaborate on this, we had a spring forming in a strong demand zone, and if it gives a strong reaction, then that confirms to us we are in a bullish market or starting to confirm that accumulation schematic in phase C. And again, we simply don't trade these on higher time frames. We have our zones of confluence, we have our understanding, and then we'll go into the lower time frame in this zone and try to understand how we can maximize our entry on the 1 minute time frame. So let's see on the next slide how this played out. As you can see, the spring was successful, rejecting this demand zone, buyers coming into the market after freeing up this area of liquidity. Now, this spring took out weak-handed buyers and tested supply one last time. And once that has happened, we had bullish break in structure. We started to have higher highs and higher lows, confirming that we are now in a successful accumulation phase. And how do we refine our entry? we monitored the spring on the 1 minute time frame to see how we can actually not enter upon the 4-hour time frame, but how we can enter on a lower time frame, therefore have a smaller zone of imprecision and therefore maximizing our risk to reward. So zooming into the spring, now we are on the 1 minute time frame, and another market cycle to discuss is reaccumulation. So previously I've discussed accumulation, and now I'm discussing reaccumulation, which was our 1 minute confirmation where we had our spring or shakeout over here, and then we had our test which provided our entry, and therefore we were trading a 1 minute time frame, therefore our stop loss was only based on a 1 minute time frame. Here on the right you can actually see our entry based on that reaccumulation where I entered upon the test, and you can see the result of that on a higher time frame, that our entry was right here in that small blue box is the reaccumulation, and then it goes on to play on a full market cycle based on the 4-hour and daily time frame. So as you can see from the precision of our entry, and actually our motto of WWE Trading is precision-based trading and precision-based education, we can see this trade generated a full 1 to 100 risk to reward and beyond because it was the beginning of a market cycle. So therefore we are able to capitalize on a full bullish market cycle from the beginning because we understood early on in the spring that we were accumulating, and we utilized our 1 minute time frame reaccumulation to confirm that entry. So how did this trade play out? At the time of recording this webinar, price is currently floating 1 to 150 risk to reward. Again, to mention the velocity of that trade, a return of 150% on your investment in just 27 days with a total risk of 1%. And another important thing to mention is trading does not need to be stressful or difficult, and it does not need to consume all of your time. Just this trade alone yielded an average of 5.8% daily for the 27 days we were in this trade, and therefore if I took no other trade in the market or if I took losses, this trade alone would cover my losses or keep my account compounding. And here on the right you can see the result of that trade. At the time of recording we can see that we are in a very bullish market derived from this accumulation phase, all originating from this spring, which we really refined down to the 1 minute time frame. So what can we anticipate from this trade? Because we have entered upon a spring of an accumulation schematic, which is the beginning of the bullish market cycle, we can anticipate after the break of the range a reaccumulation and a further expansion before we change to a bearish market. So we can see because we entered right at the beginning of a real market cycle, we are able to capitalize on an entire position trade. And as we can see on the weekly time frame, after the spring and break of range, we had 2 weeks of heavy bullish momentum in the market, which tells us that this was a very successful accumulation because it is a low resistance push. So from that first example, we saw a trade based on accumulation and reaccumulation, which is the first 2 points in our market cycle in the bullish phase. So in this next example, I want to show you a trade based on the other 2 points of the market cycle, which is distribution and redistribution. So looking at this piece of price, how would you analyze this? You'd probably look at market structure, look for potential trend lines, support and resistance levels, apply a Fibonacci retracement, moving averages, different indicators, etc. And more of an advanced analysis, again, you would look at Elliott wave count, and you would look for a zone of confluence where multiple factors line up. So this is a very typical piece of retail analysis where we have a major support level, we have our 61.8 retracement, we have a bullish market, and we have our Elliott wave count. So our zone of confluence becomes over here where we would look to execute upon buys. This trade setup would have a 27 pip stop loss and an estimated 7 to 1 risk to reward if it plays out. Again, this is an advanced level of retail trading because we have not only utilized the Fibonacci by itself, we've actually refined it based on market structure and Elliott wave. So let's see how this played out. Again, this trade gave a little bit of profit, it reacted off the zone, but it went on to break even or hit your stop loss. More likely it hit stop loss because it did not break structure over here. So reality check, what really happened? Because of this zone of ambiguity between this resistance level and the 61.8 retracement, we would not necessarily know which one to enter upon, and therefore in this example I entered upon the midpoint. And even if you were to maximize upon this trade and exit at the perfect point, you would have only gained a 4%, but in reality it would have gone on to hit stop loss and change market structure. So why did this happen? It was because we did not really understand the facts of the market, and we did not really understand what the market cycle was telling us, and therefore we are likely to get caught out on the wrong side of the market. So I ask you, ladies and gentlemen, is this really a good use of our time and capital to wait 4 days and to maximize not even at 4%, but in reality hit your stop loss because you did not understand the true underpinnings of the market? So this is how we would analyze this trade at WWE Trading. We would identify that we are in the beginning of a distribution. We understand where we are in the market cycle. Then we would go on to find points of liquidity. We would look at supply and demand zones, and therefore we would try to refine our entry. So over here on the left, we can see we have the majority of the schematic complete, and we have liquidity targets here and we have liquidity targets here. And I want to emphasize the fractal nature of the market, where we can actually see a distribution inside a distribution on a lower time frame. As we can see, we have refined our entry to a very narrow point of price because we understood where liquidity was lying, we understood where we were in the market cycle, and we understood where price needs to come to before it changes into a bearish market. Let's see how this trade played out. So we can see this analysis can be done days or weeks in advance, and if we understand the true points of the market, price will return to that very precisely, give you a beautiful entry, and then you'll be prepared for a whole market cycle if this was a valid distribution. As you can see, points of liquidity were taken out over here, and we entered a full bearish market cycle by these lower lows preceding. Therefore, this tells me this was a successful distribution. We were able to enter on a very precise point of price. So earlier on in this presentation, I recommended everyone to go ahead and check our telegrams and backtest all of our entries. This example on GBP JPY is something we called publicly, live, weeks in advance, and price respected our points perfectly. Over here we can see our original analysis, and this was our entry point, and here this is our screenshot from that telegram with the date shown. So let's take a closer look at what really was going on a lower time frame. So we discussed how we had a distribution schematic starting to form on a higher time frame, and if we zoom into a lower time frame, we can see inside that first distribution we have another distribution on a lower time frame, showing us the fractal nature of the market. We can enter not only upon the daily and 4-hour time frame, but actually down to the 15-minute, 5-minute or 1-minute time frame, and find these market cycles presenting. And as we can see, that lower time frame distribution was also respected, where the UTAD and test both lined up on the higher time frame and the lower time frame, giving us a high zone of confluence and therefore confidence in our entry. And this, ladies and gentlemen, is why we prefer to trade facts of the market as opposed to concepts and theories and strategies, because the trend line was invalidated, the support and resistance level was invalidated, the Fibonacci was invalidated. But what was respected was the true underpinnings of the market, which is this distribution schematic on the lower time frame and on the higher time frame, and the liquidity factors that were playing, and also now a bullish market turning into a bearish market by a change in structure. And taking an even closer look, because the devil is in the detail, I want to show you this is even on a lower time frame. So we've gone down from a daily time frame down to a 15-minute time frame, now down to a 5-minute time frame. We can very clearly see we have liquidity lying here, where we have 1 touch, 2 touch, 3 touch, and then a stop loss hunt, quote unquote. Liquidity was freed and provided for us an entry because we understood that this was part of our distribution on a lower time frame, with this over here, this triple bottom, becoming a target for us where we have a nice break of structure. So how did this trade play out? Not only were we able to analyze this 13 days in advance, we were able to achieve a 1 to 122 risk to reward in just 17 days. Of course, we don't hold our entire volume for the entirety of that trade. We have ways to manage this trade. In this situation, after a break of structure, we took some volume off because taking partial is very important for your trading portfolio to keep a smooth equity curve and to capitalize and maximize on moves. But if you were to actually hold this trade in its entirety for the entire duration and the entire volume, you would have an average gain of 7.2% daily. Again, as I mentioned in that previous example, not only do you take out fear of missing out, you take out greed. You can also cover your losses because every single day your account is compounding at 7% with just one trade. And here on the right, we can actually see our real MetaTrader entry, and this was our entry over here, which lines up perfectly with our analysis. Once again, the devil is in the detail. So why was this a swing trade, and how could we really understand the market was going to return to this point with such precision? At first glance, it may seem like a scalp because we had just a 4-pip stop loss. But because we truly understood at what phase in the market cycle we were, and we understood the lower time frames, we understood where liquidity was lying, we were able to actually maximize and capitalize on this trade. So now, up until this point, I've shown you 3 of the 4 market cycles. I've shown you example of accumulation, reaccumulation, distribution. And now the last one I want to show you is redistribution. In this point of price over here, we had a redistribution playing out before we had a break of structure. Usually when we come to a demand zone like this, I would ordinarily look to take some sort of profit. But the reason I decided not to do that and actually hold the trade further was because I saw another market cycle presenting, which was a redistribution, which confirms to me that we are going to have continuation of trend. Let's have a closer look. So here we can see that redistribution on a lower time frame, very textbook, very clean, very clear. And actually even on the 1-minute time frame, we had a distribution playing out, truly demonstrating to us the fractal nature of the market. So utilizing these market facts and market cycles, not only do we have precision in our entries, we also have precision in our exits, because trade entry and trade exit are both equally important. And how you manage your trades moving forward is very critical to not only have an efficient trading portfolio and a plan, but actually maximizing and optimizing your system. So up until this point, what have we seen? We have seen all 4 market cycles presented. By utilizing the market cycle and taking that down to a lower time frame, we can have really precise entries and therefore have phenomenal risk to reward, which is far beyond the average retail trader. So what is the moral of the story? The reality is risk to reward is a crucial factor for longevity in your trading career. What do I mean by this? I mean that your losses are covered, your greed is taken out, and you have more comfort and freedom in your trading, because when you put your capital into the market, you are maximizing your reward for that. So each exposure is justified and maximized. We are trading based on market facts as opposed to market strategies, and therefore we have a higher win rate as a result, and we are able to understand our losses by understanding what was the true factor that resulted in that loss. It's very important for everyone to realize that trading is about capital preservation before capital gains. This is why I like to say look at your account as a portfolio as opposed to just simply an account, and trade that portfolio as if you were trading for a hedge fund or a bank. So what are the goals for us as traders? We not only want financial freedom, we want time freedom. So if we are able to understand true market cycles and maximize our risk to reward, it gives us freedom in our trading, and it is more about quality over quantity. So let's do a side-by-side comparison on what would be considered profitable versus optimal. Right now, if you are a retail trader and you are profitable, you might have something looking like this, where you take 10 trades, 5 of those trades hit profit, 2 of them maybe hit break even, and 3 of them hit stop loss. So if you were taking into factor an average risk to reward of 1 to 3, you would have about 12% growth. But utilizing the same number of trades, the same number of profits, the same number of break evens, and the same number of stop losses, but utilizing our methodology and having an average risk to reward of 1 to 20, with those same trades in the same amount of time, you would actually have a 97% growth in your equity. And another important thing to realize is you do not have pressure in your accuracy anymore. Even though utilizing facts of the market brings precision into your trading, because of an average risk reward of 1 to 20, you would therefore need only 12% accuracy to achieve that 12% growth that retail traders trade, where they would in reality need 50% accuracy in their trading. So let's have a look at the conclusion of what we can expect from retail traders. We can anticipate low risk to reward, where the industry standard is generally a 1 to 3 risk to reward, and where they are utilizing subjective confluences and concepts that rely on probability and chance, or maybe even lagging and probabilistic indicators. Being invested in a position for weeks or months to only yield 3, 4, 5% is not very good use of our time and capital, and therefore you'd have a total slower compound effect on your account. Further to that point, we can have drawdown for days or weeks at a time, therefore we can make irrational decisions based on our emotions. Retail traders, I generally find, blame the market and blame market manipulation due to a lack of real understanding of the market, which in reality is a strategic flaw in the concepts they are utilizing. And lastly, more trades are needed to get the same return on investment. Therefore, for that same 10-20% growth, you would need more trades, therefore more exposures in the market, therefore your account or portfolio is at greater risk. So what is our responsibility? We need to actually look at our trading as not a hobby, but assume we are professional traders, and therefore we need to have a holistic view on our accounts and view them as portfolios, as I mentioned earlier, and we take a case on a trade by trade basis. Therefore, it is a necessity when we expose our portfolio to the market, the capital gains are not only justified but maximized. To do this, we need to take high probability, high confluence trades with an investment style outlook which can provide daily yield. And the key to this is swing trading by having a scalp style entry to therefore maximize your risk to reward ratio. So let's talk about what is WWA trading. You might be thinking, who are we? Who is WWA trading? What can they possibly know? And how they can have this level of precision and risk to reward in their trading? Is this even possible? Well, let me share a quick story with you. Like most of you, we battled for years retail concepts, trying to navigate how retail strategies really work and how we can be profitable inside the retail realm. We studied various resources online, both free and paid. We did countless number of courses. We tried them all, and really to no avail. We found that each new course we bought was the same regurgitated information of the last one, and we couldn't really find profitability because we were trying to apply the same concepts that everybody is trading. It felt like buying courses was more of a vicious cycle of learning, failing, and it got to the point where we felt like we were learning to fail. Nonetheless, after countless hours on the charts, we found our flow within retail trading, and we were consistently extracting small percentages from the market. Again, this is not to say retail trading does not work. It definitely works if you are applying the retail concepts correctly, but we are just saying it is not the most efficient and optimized system to have in your trading. But there were some hesitations. One, for example, when we took a loss, we really did not understand why we took that loss. We would have zones of major confluence with our Fibonacci, trend line, support and resistance, and all of the other factors I explained earlier in this presentation. But when we would take a loss, we would be left clueless or blaming it on market manipulation or a stop loss hunt. Furthermore, there was no real precision in our trading because drawdown could last for hours or days or even weeks at times. And this became frustrating because we would spend hours on the charts, hours studying, and would only get 3, 4, 5% return after a week or a month. But then it clicked. We came across the saying, 90% of traders lose 90% of their capital in 90 days. And if we think about that, if we are all taught the same concepts and we are all buying the same courses and we are all trying to implement the same strategies and 90% of those people fail, maybe that is where the problem lies. If we are all utilizing the same flawed concepts that are based on probability and chance, that is why 90% of traders fail. Think of it like this. Would you apply to a university course knowing 90% of people fail? We knew that to be in that top 10% of profitable traders, we had to shift our paradigm and start to understand what really moved price and trying to understand what are the facts of the market. So that's what we did. We built our system around facts of the market. We hybridized different concepts and schools of thought such as Waqar theory, which comprises about 20% of our trading style, in addition to many other factors. But the key for us was really when we started to understand the lower time frame and have real precision in our trading, taking trades on the 5-minute time frame or the 1-minute time frame, or on occasion even on the seconds time frame. We found that these refinements led to continual breakthroughs and revolutionized our trading. Coming from an average risk reward of 1 to 1 or 1 to 3, we were now getting 1 to 10 risk reward consistently, and at times we were getting 1 to 50 or 1 to 100 and beyond. But we knew we could do better. So this next point in our trading journey was really critical. This is where the three of us united our thoughts, united our strategies, and really started to refine and progress. WWE Trading stands for myself, Waqar, my friend Wali, and my friend Alex. So the three of us came together and we started to trade every single day together live on Zoom, 6-7 hours every single day throughout New York session. And we would start to analyze and give each other feedback. We would start to refine and we would start to dig deeper into backtesting and refinement of the market. Our methodology was, before we add anything into our trading methodology, we would backtest it, refine it, stress test it, and then apply it. What do I mean by stress testing? I mean, if we come up with a theory or a concept we like, we would fund a live 1K account and we would trade that account, only modifying that variable to see what kind of effect that would have on our trading. If that stress testing process provided profitability, then for us it was justified to implement that into our real trading plan. After months of doing this process, our risk to reward starting to increase from 1 to 10 to 1 to 20 to now 1 to 50 or 1 to 100 and beyond. But this is not just us saying this. We also have countless number of students who are replicating these kinds of trades with the same level of precision, and we have many students who have achieved that 1 to 100 risk to reward trade, which is a major milestone for us. So how can we help at WWE Trading? So let's talk about the three main barriers that all traders face. First of all, it is lack of knowledge. By trading various schools of thoughts and bouncing between concepts and not really finding consistency or profitability, it can come to a point where they feel like they have analysis paralysis. Second of all is a lack of capital. What do I mean by this? A 50% return on your account would be considered a phenomenal return by any trader's standards. But if you are only trading a $1,000 account, this would not be sufficient to become a full-time trader. And as I mentioned previously, having a poor risk-reward ratio affects your whole portfolio because now you have pressure on your win rate and now your psychology becomes a huge factor. So let's tackle these three issues one by one. So first of all, lack of resources and lack of knowledge. So here at WWA Trading, we teach our entire methodology in our bootcamps where you have several days of live training from us, and of course you'll have continued access to all of the educators for the following weeks and months and years. Another advantage is you get to be part of the WWA Trading community. Now, this is a very powerful thing because now you are part of a community of like-minded individuals who all have the same goal, who all have the same aspirations, and are all working together to help each other become the best versions of themselves. We believe at WWA Trading it's not just about having optimized your trading system, but it's also about having growth in yourself as an individual. And it's important to mention as well that we do have an extensive aftercare system where we like to provide live chart analysis, live feedback, and question answer sessions on Zoom. The second problem that traders face is a lack of capital. So therefore our solution for this is to provide funding for our students. We provide in-house funding from the educators, but we also facilitate and aid students to achieve external funding from private investors. And lastly, the main problem that traders face is a poor risk-reward ratio. Therefore, we teach our entire strategy to students, giving you an edge in the market, which allows you to have high risk-reward, high probability setups. We now only expose our portfolios to the markets if the reward is not only justified, but at least 3 times the industry standard. This may seem impossible to some of you, and that's normal to be skeptical. That's why for over a year we have documented most of our trades publicly, which is across our social medias and Telegram pages, which I encourage all of you to go back test and study and see how we were able to achieve these phenomenal 1 to 100 risk reward trades. And I just want to emphasize, what is the benefit of trading high risk reward? First of all, fear of taking losses is mitigated. Second, there's less greed in the market. Your fear of missing out is removed and you're subject to less overtrading. So now let's talk about the WWA Bootcamp and the education services we provide. The first part is 3 full days of Forex Technicals, which is where we teach our methodology from a technicals perspective. This is divided into 9 training blocks, each lasting 2 hours. And we also have question and answer sessions and follow-up sessions where we can actually speak to you as individuals and answer any queries or doubts you may have. So the first 3 days where we cover our methodology and our technical system, this is how it will be divided. In the first day, we will have 3 blocks where we have retail outlook, trend analysis, and wave analysis. The second block will be structure and advanced structure, because we believe this is very critical for the foundation of any trading plan. And as the last block on day 3, we'll cover some more advanced concepts and also talk about how to manage your account and how to manage your trades. Coming on to day 2, we will also have 3 training blocks, which will be more advanced concepts and talking about institutional traps. We will delve deeply into Waqar theory and talk about how to really apply Waqar theory. And the last block will be some more advanced concepts where we start to go into the lower time frame and explain how you are able to take trades with precision on the 1 minute time frame. And lastly, on day 3, we will give you some set of rules and talk about what we consider prime setups, and we will cover many examples, giving you a full top-down analysis from the monthly time frame down to the 1 minute time frame and our thought process in its entirety. And at this point, when you have seen us break down multiple trades, you'll start to understand our thought processes and start to gain our market experience and market IQ. And lastly, in the follow-up days, these will be more interactive sessions where we can address all of your questions, misunderstandings, or queries. And this is actually where you can share your charts with us, share your screen with us, and we can give you live feedback. We will cover all frequently asked questions and give you a blueprint of your evolution with us. We will teach you how to become efficient at backtesting and a competent analyst in the preceding months. After the bootcamp, you'll be introduced into our community, where we have a platform where we like to provide extensive aftercare for our students. There we will host regular Zoom calls and have a platform for you to engage with all of the educators and also engage with all of the current students. And I have to emphasize, having a community of students who all have the same ambitions and goals as you is a very powerful place to be. So what is our criteria? Our education is not designed for beginners. We want you to be familiar with trading basics and all of the terminology so that we can build upon that with the more advanced concepts that we teach. Our ethos is actually to become an analyst before you become a trader, and this is something I emphasize to all of our students. If you can really learn the skill set, the money will follow. And one thing I require of all of our students is you have to have a strong work ethic. We do not spoon feed anyone and we do not hold your hand. Rather, we like to create an environment that helps you facilitate your goals to becoming an independent trader. So ladies and gentlemen, we have now reached the end of the presentation and we have spoken about our entire methodology and what kind of things we offer. So I have just 3 questions for you. 1, would you like to have a higher risk to reward in your trading? 2, would you like to have more capital? And 3, would you like to be part of a community of like-minded individuals? So if the answer is yes, at the end of this webinar there will be a link where you can book a call with myself or one of our team members where we can answer any questions you may have. So go ahead and click that link, book in a call with us, and I look forward to hearing from you.